the earnings so far from the U.S. Are what most beating estimates. We got the estimates from Microsoft today, of course, not a little bit disappointing, but they still closed higher. What does it tell you about the U.S. stock market and the appetite of investors around the world to keep buying stocks?
Well, it's the earnings which is underpinning that demand. Obviously, we have these worries about higher inflation, higher bond yields. But if earnings make up for it, then it's not a big threat. And that's what we're seeing here, that each time we have a US earnings reporting season, at least since the March reporting season last year, US share market has increased because US companies have surprised on the upside. And of course, this time around, the same thing is happening. We're seeing companies beat on average by about 13 percentage points. I know that's skewed a little bit towards financials who are releasing loan loss reserves. But even if you strip that out, companies are beating by about 8 percentage points. So that's a pretty good outcome. And it obviously keeps the valuations on share markets manageable, even though we're seeing this backup in bond yields.
You know, there's a lot of hand wringing, certainly over the rise in bond yields, but just about the idea that rates are going to move higher. Oh, that's bad for stocks. But of course, if you talk to a lot of people who actually own and run companies, they tend to be they're more concerned about how fast the economy is growing, whether or not their taxes are rising. And if they can keep making money with interest rates rising, many of them say that's fine. So how do you expect this fear of rising rates to play out?
Look, historically, when rates have gone up, initially it's a bit of a negative. It's a bit like when central banks start talking about tapering. Initially, it's a bit of a negative. But once it starts occurring, I think the market adjusts to it, providing the economy is not collapsing, providing earnings are still rising, and monetary policy is not overly tight. Then the share market can continue to rise. Historically, it doesn't go up as rapidly as it does at the start of a bull market when you're coming from cheap valuations, ultra easy monetary policy, no tightening in monetary policy in sight, shares rocket higher. That's what we've seen for the last 18 months. So the environment is now changing, and that's going to constrain the rate of increase in share markets. But historically, higher rates initially are not a negative. They only become a problem when rates reach onerous levels. And I think we're a long, long way away from that in the US. Obviously, we haven't even started raising rates, but in most other countries around the world, we've got a long way to go before higher interest rates crunch the economy.
In Asia, though, you do have central banks starting their tightening cycle, as well as a lot of people saying we're starting to see the sort of downturn in the profit cycle as well, right? How much does that impact and how much is that playing out when it comes to the gap between US, European markets and Asia? And where do you find the opportunities in this part of the world?
Well, it is a bit messy. Asia, of course, did have that COVID problem a few months back, and that sort of led to slower growth. But I reckon if the global economy generally keeps going, then that should be good for Asian economies, because they benefit from increasing trade and exports. And of course, that should lead to another fillip in Asian growth. And therefore, I think even though the earnings season or earnings growth has started to slow in Asia, it may have another perk up as we come into next year. So I'm not particularly concerned about that, but obviously different parts of the world will be at different parts of the cycle at different points in time. And of course, like only a little while ago, it looked like Europe was starting to shoot the lights out as it got COVID under control, but the US was in a problem. Now it looks like it's reversing a little bit. So a lot of it, COVID is still at the centre of a lot of this, causing a lot of noise across countries, across markets, obviously having a big impact on the inflation situation. And until we get the pandemic behind us, and it's still not quite there yet, that's going to cause that ongoing volatility and, in many ways, ongoing opportunities for investors.